Well, the Office for National Statistics said today that average weekly earnings during the period rose by 2.8%, including and excluding bonuses. And that was the strongest growth since the summer of 2015. Consumer price inflation in February was 2.7%, meaning that real wages rose by 0.1%. That's the first time since February last year. And the ONS also revealed that the unemployment rate fell during the period to just 4.2%, which was the lowest since May 1975. Well, with me to discuss this, it's the economist Vicky Pryce. Vicky, very good to see you. So do you think this marks the end of the squeeze on real wages? Well,
the first thing to say is that it's good news because, of course, we've had such a long period of falling real disposable incomes, which, of course, has had huge impact on people's willingness to go and spend. Yes, I think what is happening right now, of course, is that the pound has strengthened against the dollar at any rate, against which so many of the things that we import are priced. And that has helped the inflation rate, which is really good news. Wages are creeping up mainly because of shortages that are already quite prevalent in a number of sectors. And that's good news too, because it means that finally, certainly if we look ahead in the next few months, there will be hopefully something more substantial there in terms of the gain that workers will get in terms of real wages. So I think, yes, I think unless there is any serious change in terms of the inflation rate caused by any drop now in the pound, which is unlikely, we are probably beginning to see a slight improvement happening in the next few months. Not huge, but a slight
Well, that's good news. I mean, 4.2% unemployment, that was probably the standout feature of these numbers today, wasn't it? I mean, shouldn't we be seeing higher wages inflation in the light of that sort of level of jobless rate?
I think we probably should, but if you look at what is happening in various sectors, remember quite a lot of the increases in jobs that have taken place have been in quite low wage areas. They've been in the gig economy, they have been in places where actually average wages are quite low themselves, so lots of part-time work taking place, which again is not particularly highly valued. So what you're seeing is that in a number of cases, of course, where there are serious profit issues, such as in the retail sector, there is really no ability or no willingness to give extra increases in wages. And I think that's what's keeping them down, despite the fact there is clearly a shortage in so many areas right now.
What was encouraging about these numbers, though, is that there are genuine full-time jobs being created. That is where the bulk of job creation is coming through. It isn't just part-time work, it isn't just gig work, is it?
No, this is absolutely true. But nevertheless, what you've seen for quite some time now is that those types of jobs that are around, the gig economy jobs and so on, are setting some sort of basis for what people are getting paid per hour. And of course, what we're going to be seeing increasingly is the impact of the increase in minimum wage, which is going to be influencing wages over the next few months. And I think that's quite significant. I think what we might see, therefore, is that people are more willing to come into the market and do more of that work, because participation rate, interestingly enough, went down. So I think those low wages generally have discouraged people from coming in and moving from benefits and coming into work.
Does it follow, though, that this is going to put more money in people's pockets? I mean, another big change that we've got coming through at the moment is that people who are automatically enrolled into pension schemes are going to see a big increase in their contributions this month, which eats into their take-home pay.
That's a real issue. And of course, if interest rates go up, as they're likely to as well, so we're going to see some impact on that on mortgages. So many people have mortgages which are interest only, and that's going to be a problem for them in terms of keeping up their payments. What we're seeing already, actually, is that the consumer is being much more cautious. They're not spending things on non-essentials. We've seen that happening, for example, in the car sector, in addition, of course, to the problems because of diesel cars as well. But we've seen that very significantly showing there. And we've seen that it's mainly on sort of food and essential items that people are spending their money on. Retail sales have suffered as a result. And what you've got actually out of the latest data coming from Visa, which is looking at how people are spending, you're seeing a drop in spending, a significant drop in spending happening month after month. People are worried about the future, despite the fact that employment is such a high level.
I mean, you just put your finger on the major point there. Does this mean that an interest rate rise next month is nailed on?
I don't really think there is any serious need for increasing interest rates. On the other hand, of course, if you haven't got something to bring back down, it's going to be a problem if the economy slows down. So I think we're probably going to see that increase. I think it's going to be an issue for consumers if it carries on. Hopefully that will be it for some time, although people seem to think that we may get another one later on. With inflation coming down, and will improve, I think, in the next few months, unless there is some serious crisis in the oil market, for example, a war or whatever may happen geopolitically, then I think that actually the interest rate increases we're likely to see this year are going to be very, very modest.
Well, the oil price is up some 24% since the beginning of October last year. And of course, we've seen the likes of British Gas raising prices already. You're not too concerned that's going to feed through to aggressive hikes in inflation?
I think it will feed through to some increases. There's no doubt about that. I'm not expecting that we're going to see a real substantial fall in inflation, but we're going to see inflation which is comfortably within the margin that doesn't require the Governor of the Bank of England to write a letter to the Chancellor of the Exchequer. So in other words, it will stay below 3% unless there is some serious change in the markets. And yes, you're absolutely right about the oil price. It has been going up. It's still much lower than it has been, for example, in the previous years when the world was growing as fast as it is now. We would have been expecting actually to have oil prices considerably higher, and we haven't seen that. The reason why they're strengthened now is not so much because of world trade being so strong as it has been, which has helped the economy. It is really because of the uncertainty in the Middle East.